Okay, welcome, folks. Um, I don't know, it's just 1 p.m. Well, let's see if more people joins later today. Let me check how many people we have right now. We have 4 guys. Okay, we can start with you guys, and then we can, you know, as people arrive, the good thing about Google is that it has kind of the video recording. They can start from the very beginning. So what we have in store for today is something simple. We have basically people already posted some questions, and we are going to go over them right now. So we'll see. Let me see what questions we have. We have here how to read the new H tables, which is it's a very good question. I've been posting the new H tables, and I know people are interested on reading them. So let's do that right away. Let's compute an H table for SPX right away here. I hope you see it. You know that I love to. So right here in this corner we have an H table. I hope you can see it from here if I highlighted. This is an H table. And this is for October 5th. October 5th is not this Friday, but the one afterwards. So it's kind of 2 weeks, 2 weeks and less than 2 weeks, a couple days less than 2 weeks. And what does the H table do? So the H table is a simple computation where you can see the levels right here, and it shows you the odds that a particular underlying, in this case XPX, hits that level. So you can see, for instance, that 2940 has 55% probabilities of being seen for October 5th, which is, I will say, that is a really good probability. I mean, that's a tremendous probability. It will be a great trade. So you see the probability, and it shows you in the next column, it shows you the cost of a binary call for that particular strike. So the binary column is the cost in binary pricing, which just goes from 0 to 100. So you can see that the binary option costs 40%. So right there, you can see there's a nice edge on that trade because the probability is 55 and the binary is only priced at 40. So, and then the next column is the cost in raw dollars. It costs you $2 per contract to enter this trade. And it shows you the edge. The edge is in a normalized to 100. So the edge is actually good. It's a very good edge. 37% edge is a fantastic edge. So right there, that's how you use the edge tables. You look for it's levels that you think the market will get, levels with good probabilities and with lower cost. So in this case, I mean, $2 is kind of expensive. You don't want to enter a position at such an expensive value. So what you're looking here is you're looking for some kind of compromise between cost and probability and, of course, edge. So for instance, we are already right in this one right here at the bottom. And with the fall of the market, this position is actually getting cheaper. It's now 30 cents, and it has a probability of 16%. Now it's getting lower and lower, but I'll come back to this later. But it's still, the binary is underpriced, so there is still edge in this particular trade. So that's how you read the edge tables. They can be computed for any symbol, no? But as I have mentioned in the room before, it makes more sense for index options, for something like SPX. The edge in SPX is more prevalent, and also index options, or the index itself, tends to be more stable. So when the index has a trend, the trend tends to remain. No, the index is not jerking back and forth. It's not like a Netflix or Tesla that could be trading at a certain level and suddenly drops or suddenly goes up. An index you have is more stable. So these predictions that, of course, remember, these predictions are assuming that the trend will persist, are more accurate. You know, we'll have I think we'll have better results using something like indexes for these trades as opposed to single options, but they can be used also for single options. I'm going to quickly check if you have any questions about this. Let me see. No questions yet. By the way, you can type questions. If you have any questions, you can type them on the little chart. So on the little chat here, let's see, this is a demo. So right there where I just type, you can type your questions, or perhaps you can see questions on the chat. Let's see, here on the chat room, nothing here yet. There is a delay of about 20 seconds, 10 to 20 seconds. So if you type a question, it will take a little bit for me to see. So, okay. So we're doing edge table. So hopefully it's clear. If you have questions about them, just let me know, type them, feel free to type them. We can revisit them later on. I'm going to, this is a quick question. It is worth answering. I got a question about, okay, where to trade VIX futures? So yeah, VIX futures can be traded in any place. The exchange for VIX futures is called the CFE exchange, and it's available to all of you, any broker. The only thing you have to do is open a futures account. If your broker supports that, then you will have access to VIX futures, like Thinkorswim, Interactive Brokers, I don't know, any retail broker, Charles Schwab, Fidelity, they will provide you access to futures, and they can provide access to VIX futures. We have another question, which is risk reversals for the naive or the NDLA strategy. Okay, so that's a fantastic question. You know that we have the NDLA trades. Let's check quickly on an NDLA trade right here. Let me do it for you really quickly. So right now we have, this is the NDLA trade, and you can see that we have a positive signal for next week. So right now we are getting this nice positive signal with a probability of 50%, which is right there. I mean, it's in the limit of positive and negative. It's like right there in the middle. But it's a good trade to take. I mean, this is the first time in a long time we haven't seen a positive signal in 12 sessions. So it becomes an interesting trade to make, and I will say that yes, we should do it. And the target is 2,948. So we round the target. The target should be something like 2,950. And we price the binary. Let me price the binary for October 3rd. This is the binary. And it shows the target of 2,950. And it shows the cost. The cost is 125. 125 is right there. It's a little expensive trade. Remember that my limit for NDL trades is 1.5, so it's lower than the limit. It becomes interesting. But the question on the people saying is, can we? This is just a pure binary call option, which is done with the spreads. And the question is, can we do this with a risk reversal? And the answer is yes. I mean, if you really trust this thing, you could do a risk reversal for the same date. And the long leg of the risk reversal is this one, which will cost you 125. The only thing you have to do is pick a short leg for the risk reversal, like a vertical. You just sell the vertical, put a spread. It's something, could be, I don't know, at 2,900. Let me check let's see, let's look for put spreads to sell against this thing. Let's see if I can get good put spreads for XPXW for October 3. And let's look for a spread and strike of 1,900 and see how much is it. And it costs 1.2. So if you sell this one, if you sell the 2,900, put a spread, you'll get almost the cost of the call spread. So it's still not quite, it will be like a zero cost risk reversal if you wish. I mean, if it fails, it will give you, you won't get a lot of credit. If you are willing to go a little higher, like 2,905, for instance, then the spread costs 1.4, and that one will give you a credit. So yes, so you can do a risk reversal. And how does a risk reversal? You sell this spread and you collect 1.4 credit, and then you buy the vertical spread, which is 1.25, and you get a little credit of 15 cents. And what did you do there? I mean, what is the whole point of doing that? The point is that if the market doesn't move, or if the market moves up but not quite to the limit, you get to keep the credit. No? In other words, if the trade fails because of the market just became really stable, you get to keep the credit, or you get to like exit the trade at a small loss, or actually at a profit. But of course, there are no free lunches. So what is the drawback? What are the risks associated with a risk reversal? Well, the risk is that if the market falls below your limit, the 2,905, then you are in the hook for a bigger loss. The loss is 5 minus the credit received, no? So the loss will be something like, in this case, 3.6. So you're risking more right now with the risk reversal, but you're giving yourself more room. So it's something that you have to kind of evaluate. In this case of the binary call, you're risking 125. But I mean, in order to make money, the market has to go over 2,950, no? While in the risk reversal, the market can just remain. The only thing you need to do to make money is for the market to be above 2,905. So it's a decision you have to make. And I open the thing to questions. Please let me know if you have a question. I'll check if I have questions. No questions yet, but hopefully if someone has a question about the risk reversal, speak now. Let's see. I'm just going to pause for 10 seconds to give time for questions about the risk reversal. Well, no questions yet, at least here, and no questions here either. So, okay, let's continue with what we have. See, we have questions here. No questions here. So, that was the question that I got about the risk reversal. Now, let's look at VRP discussion and potential trades for it. Okay, so this is another question from one of our members. He wants to look about variance risk premium. I mean, I talk about this all the time, and I have tables that show the variance risk premium now. And the question is, can we profit from it? And the answer is yes. There are ways to profit from the variance risk premium, and one trade that works is precisely this kind of risk reversal. This risk reversal is a great trade that works for VRP, just to pocket the VRP. What is the trick? The trick is, if you notice here, the lower strike of the risk reversal tends to be substantially more expensive than the upper strikes, even though the distance is more or less the same. I mean, the question is that you have to add a longer time. I mean, it cannot be short term. So the one way to strike VRP is doing risk reversals, but like 90 days out. So you pick 90 days out, which is like we are September, October, November, December, January, something like March or April, no? So you pick a risk reversal for March and April, you will notice that the put spreads are way more expensive than the call spreads for similar distances. And that's how you collect the thing, because you're allowing the market to be in a gigantic range and you're collecting a premium with that. But you have to ride the trade for 90 days and you have to let it expire. No? So you're assuming a little bit of risk with that trade. But it's one way. I think I will have to do like a full video, because I don't think that I can discuss every single strategies, but at least I just want to pique your interest that risk reversals are one way of extracting variance risk premium from the market. Finally, let's look at the volatility outlook for SPX. So that was another question I got. So for that, let's look at the volatility center. So what are we seeing today first, and then I look at like longer term. So today, let's focus on this area, which is the variance chart for SPX. It's one of my favorite tools of all the Momentum Center, which, by the way, is free, guys. You can use it. Just use it. It's available to you. So make use of these tools. And it shows you, this chart, what it's showing you is the intraday variance along the day. No? So you can see that initially around the open, we have lots of variance. The gray dot says lots of variance, like 13%, 10%. But then as the day progresses, the market becomes more subdued, which is natural, no? Like most of the action is at the open, and then the market kind of stabilizes. And then you'll notice that by the end, the market will start again getting a little bit more active. But the important thing here is not the trend, which is represented by this magenta line. You can see that the trend is a decreasing trend. And the absolute value, this is the realized variance today, which is nothing, 4.7, 4.69 is basically no variance. We don't have, the market is not moving today. This is basically is very close to zero. No, in terms of volatility and variance, something like 4% is equivalent to say zero. The market hasn't really done much. And you can see here, it looks kind of active, but you look at the range is like what, 5 points, 7 points. The market has been trading with a very tight range, and it's showing here. What does it mean? What does it mean when you see such a low values of volatility and variance? It means that there are not really a lot of market participants in the market right now. And without even looking, I can tell you that trading volumes today are really low. And it's something that you can check. Go check in your favorite trading platform, check trading volumes, and I bet they'll be substantially lower than average. And that's one of the reasons for the low variance. Low variance is basically a consequence of low trading volumes. And it makes sense. It is very consistent with a week where we have a meeting of the Federal Reserve. They are meeting right now. And tomorrow we'll have an announcement for interest rates. So you will notice that the announcement is the thing that will cause a lot of movement in the market. No? So that's what we have right now, and it's showing that, well, okay, what else does it mean? When you see a day of 4.69, don't expect the market to crash today. The market won't crash today. This means that the market will be range bound, expected to close flat or a little higher, just a little upside drift. And you can see, okay, now let's look at this implied trend, which is also related to volatility. The implied trend shows you the weekly returns of the market, and you can see that we have positive weekly returns, but the momentum seems to be stalling. And this is expected to. The momentum was very positive in September 10, but then it's kind of like it has been stalling towards the end of the month. And this is normal too, and I think this is related to the meeting, to the Federal Reserve meeting, because market is just awaiting. It's funny because we know that they are going to raise interest rates. We know it. It's not a surprise yet. Traders seem to be acting like it's a big surprise and waiting for what is going to happen. And so my outlook for volatility in general is that I was expecting September to be very volatile. I was really expecting lots of volatility in September, but instead what we got is this. We got, for the past month, we have a realized variance. You can see it here in the lower corner. For the realized variance is only 5.89%, 5.9% of realized variance for most of September. That's unbelievable. That's incredibly low. It doesn't align with seasonality. September historically has been a very active month. It has been a month of lots of trades, lots of volume, lots of volatility, yet nothing has happened this September. There is still a few more days on it. We have until Friday for something to happen. Maybe something will happen. But famous last words, my guess is that we will close September in a low volatility, and that killed one of our trades. We were trading volatility for September, and it didn't pan out. So that's one of the reasons that trade didn't work. And my expectation for October is seasonality. October has always been a strong month in the market, usually upside momentum, which means even lower volatility. So I guess the near future is full of low volatility in a normal market. I don't know if you guys will think that this is a normal market or not. Let me quickly check. Okay, finally I have some questions. I guess this is related to the risk reversals. You risk less, but only if you are sure market will lift. Of course, Paul, that's correct. The risk reversal, this is related to the risk reversals in general. You are gaining an extra edge in the risk reversal, which is the range-bound market action, but you are introducing an extra risk, which is natural in the market. No free lunches, folks. Remember, there is no free lunches in the market. So yes, you have to be convinced that your thesis is really good, which is the case with the NDLA. If the positive signals of the NDLA have a tremendous success rate, about 70%. So I will actually mix risk reversals with NDLA signals, no? And another one for from Sri. It says that you can play risk reversals longer term. Yes, that, as I mentioned, the risk reversals are like they are more efficient, probably 60 to 90 days out. It will give you a tremendous nice range, so you can play in a wider range. And if you make use of the fact that we are in a bull market where the market has upside drift, then you can use that also for your risk reversal. Use gamma optimizers instead of the NDLA in case over a week time horizon. Well, no, I mean, you do it by hand. I don't have a tool. I should, this is a collection of ideas. I should create a tool that allows you to select risk reversals based on your parameters. The gamma optimizer is only for single options. Now, a risk reversal has 4 different legs, the binary risk reversals we use. So no, the gamma optimizer is not there in the picture. You have to kind of price the spreads by hand. No, you have to go and look for the spreads yourself, price them by hand, and find an interval that has a really good credit. No. Another question from Eric. It's a very good question. Can the NDLA code run on other indices besides XPX? I actually have a video when I go over the reason why I only use it for XPX. Maybe I can do it. Maybe we can try for indexes like NDX or QQQ or something like maybe Russell 2000. It might work. For individual stocks, forget it. It won't work for individual stocks because remember that one of the things we need for the NDLA is the structural thing. We need the volatility smile to be a frown. We need puts really overpriced, and we need calls underpriced, and we need a little bit of positive skew on the call side, but not too much. So that's what we need. So that kind of a configuration of the volatility smile is only present in index options. It's not present in single stocks. So we could give it a try to other indexes. However, remember that if you look at the video for the NDLA, you will notice that of the 11 inputs, a couple of them only apply to XPX. So we will have to either create a new set of inputs or kind of synthesize them for other indexes, but for sure it's something that could be explored. That's a good thing that I have questions. Let's see. Oh well, and now I have open questions. Before going to the open questions, let's check out what we have open right now. So the positions is really one position here what we have open, a binary triangle, and the high big N of the world is the short leg of the binary triangle. So this is just basically only kind of like a little price out of the position. I just put it as an extra so people could track that leg because I know some of you were trading only that one. But the triangle didn't work at all. The triangle cost 45 cents and they are gone. No? And that was the risk we took when we entered this triangle, because we assumed that we were going to get higher volatility in September. We didn't get it. Fine. I mean, it's only 45 cents. We have the long-term butterfly that I know most of you already closed it. I have not closed it yet. I am writing this because I was expecting a little bit of market being a little bit range bound, a little longer. So this long-term line is behaving fantastic. Right now, the net profit is 145, which is more than 200% return right now on this. And this is a trade that I am doing in a little size, and I know some of you are also doing in a size. So the longer the market stays in this area of 2,920, the better is for this for our butterfly. But I'm keeping an eye on it and ready to completely close it. I've been taking little partial profits, and that's kind of like the only long-term official positions that I have. This binary triangle will get off the books, will be taken off the books pretty soon because it expires on Friday. There is an outside. By outside, I mean very unlikely 3 standard deviations away probability that it might work before expiration, but for all practical purposes, forget about that. And that's it. If you have more questions, folks, I guess I try to keep it short, the live video. If you have questions, then now is the time to put them here. Oh, Paul, would love to see seasonality data for various tickers. It is very easy to compute. I mean, seasonality is very simple to compute. You could There are many ways to do it. Like the data is available. You can get the time series for all of the stocks that you are interested in, and you can run lots of what I call correlations. I mean, it's not correlations. It's what I do to look for seasonalities. I do random effects modeling. I think I get a trend, and then I do random effects per month, and you can see seasonality every month. If you want in the room, you can ask me for a ticker or for whatever, for anything that you are interested about seasonality, and I can. Oh, you would love to be part of this. Yes, I can do it for you. I mean, it's very easy to run. I have done it in the past. When people request, I post the seasonal tables, and it's a table by month, and so you can see kind of like the seasonal patterns per month. Any other questions, folks? Just keep it open for a few more seconds, and I think that will be it for the live video. I really appreciate you folks coming, and this is the first one in a while. Okay. We have so this is the trade for October 5th. No, I have the trade. The trade is very good. We are going to make money on that trade. It is, I think that we have a positive edge. We'll see tomorrow after the Fed release, once the Fed releases the decision about interest rates and the outlook, and I expect the market to take off. It might crash, no? We don't know. Like, I mean, we have no idea, but it's more likely the market will resume the upside drift, and so if the market continues going up, it will benefit our positions. Our positions are actually not that bad. I have entered at 2 prices, and it's, I entered at 65 cents, and then I entered at 40. So I think I intend to keep them a little longer. So we'll see. Anyway, okay, folks, I think that was it for today. Thank you very much for joining. And of course, as usual with these live videos, they will be recorded in YouTube. I'll provide the link once YouTube processes the video and records it. Thank you, folks. Take care.